Published in 1934, Security Analysis by Benjamin Graham and David Dodd emerged from the crucible of the Great Depression. It provided a rigorous framework for evaluating financial assets in a chaotic market. This seminal text laid the groundwork for what is now known as value investing. The book sought to transform security analysis from a speculative art into a disciplined profession. Graham and Dodd emphasized the importance of fundamental analysis over market sentiment or technical patterns. Their principles remain highly relevant for serious investors and analysts today. A central tenet of security analysis is the critical distinction between the market price of a security and its intrinsic value. Market price is simply what someone is willing to pay at a given moment. Intrinsic value, however, is the underlying worth of a business or asset. Graham and Dodd argued that market prices often deviate significantly from intrinsic value due to factors like emotion, speculation, and short-term news. The intelligent investor's task is to estimate this intrinsic value through careful analysis. They then exploit discrepancies between price and value. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries. Perhaps the most enduring concept introduced is the margin of safety. This principle dictates that an investor should only purchase a security when its market price is significantly below their calculated intrinsic value. This difference provides a cushion against errors in analysis or adverse market events. The margin of safety protects capital and increases the probability of a satisfactory return. It acknowledges the inherent uncertainty in financial forecasting. It is not merely a quantitative buffer, but a qualitative approach to risk management. Graham and Dodd defined the security analyst's role as determining the investment quality of securities. This involves a thorough examination of financial statements, business models, industry conditions, and management quality. The analyst acts as a detective, uncovering the true economic reality behind the numbers. The analyst must be objective, skeptical, and diligent. Their work provides the basis for investment decisions grounded in fact, not speculation. This professional approach contrasts sharply with trading based on rumors or market momentum. A clear line is drawn between investment and speculation. An investment, according to Graham and Dodd, is an operation which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Speculation focuses on anticipating market price movements. Investment focuses on acquiring assets based on their underlying value and earning power. The book strongly advocates for investment and warns against the pitfalls of speculation. The book dedicates significant attention to the analysis of bonds and preferred stocks. It outlines criteria for assessing the safety of principal and the reliability of income streams. This involves examining the issuer's financial strength, earning power, and asset coverage. Emphasis is placed on the seniority of claims and the terms of the indenture. Analyzing fixed income securities requires a conservative approach, prioritizing preservation of capital. This section provides detailed methods for evaluating creditworthiness. Analyzing common stocks is presented as more complex than analyzing fixed income. The value of a stock is tied to the future earnings and dividends of the business. Graham and Dodd provided methods for estimating earning power and asset value. They cautioned against relying solely on past performance or optimistic projections. The analysis must consider the stability and predictability of earnings. They introduced concepts like capitalization rates and the importance of tangible assets. A deep understanding of financial statements is fundamental to Graham and Dodd's methodology. The balance sheet, income statement, and cash flow statement provide the raw data for analysis. The book details how to interpret these statements critically. It highlights potential pitfalls, such as misleading accounting practices or hidden liabilities. The analyst must look beyond the reported figures to understand the economic substance of the business. Financial statement analysis is the bedrock of intrinsic value estimation. Security analysis remains a cornerstone of financial literature. Its principles of value investing, margin of safety, and rigorous fundamental analysis have influenced generations of investors. Warren Buffett, a student of Graham, is perhaps the most famous proponent of these ideas. While markets and financial instruments evolve, the core concepts of understanding value, managing risk, and maintaining a disciplined approach endure. The book teaches investors how to think like business owners, focusing on the long-term economic reality rather than short-term market noise. It is essential reading for anyone serious about the craft of investing. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries.